Imagine a financial system that's actually bigger than the banking system. A system moving trillions of dollars every single day. Yet most people have never heard of it. But here's the important part. If something breaks inside that system, it doesn't stay there. It eventually reaches your bank, your retirement fund, your mortgage, and the stock market. Today we're talking about shadow banking. The name sounds mysterious. It's not. But it might be one of the biggest risks in global finance today. Everything in this video comes from the public reports published by the IMF, the Federal Reserve, and the Financial Stability Board. And what's surprising isn't just how enormous this market has become, it's that regulators repeatedly admit they can't see all of it. That's not exactly reassuring. So let's start with the obvious question. What is shadow banking? Despite the name, it's nothing shady or hidden in dark alleys. Shadow banking is simply lending that happens outside traditional banks. Instead of your local bank making the loan, it's a hedge fund, or a private credit fund, or a money market fund, or even an insurance company. They're doing banking activities without actually being banks. That means fewer regulations, less transparency, and fewer safety nets if something goes wrong. Now, this isn't new. In fact, we've been here before. Back in 2008, most people blamed banks for the financial crisis. But a huge part of the problem actually came from this exact corner of finance: off-balance sheet vehicles, complex funding markets, products almost nobody understood until Lehman Brothers collapsed. After that disaster, governments spent years making banks much safer, and they largely succeeded. Banks today hold more capital. They're tested more often. They're far more heavily regulated. But here's something finance teaches us over and over again. Risk rarely disappears. It just moves somewhere else. And that's exactly what happened. The loans banks stopped making didn't stop existing. Someone else started making them. And over the last 15 years, that someone else became enormous. According to the Financial Stability Board, non-bank financial institutions now manage almost $257 trillion in assets. That's over half of all financial assets on Earth. Think about that for a second. For the first time in modern history, most of the world's financial assets sit outside the traditional banking system, and they're growing even faster than banks. One part of this world worries regulators more than almost anything else: private credit. Instead of borrowing from a bank, companies borrow directly from investment funds. Today, that market is worth roughly $2 trillion. Now, private credit isn't automatically dangerous. In many cases, it's actually useful. Companies get financing, investors earn attractive returns, everybody wins. The problem is visibility. When a publicly traded stock crashes, everyone sees it instantly. When a private loan starts going bad, only the fund manager knows. And because these loans aren't traded every day, their value depends largely on the manager's judgment. Sometimes losses appear months later, sometimes much later. Then came late 2025. Two companies exposed just how little people really knew. The first was Tricolor, a Texas-based lender specializing in subprime auto loans. It suddenly collapsed amid fraud allegations. JP Morgan alone lost around $170 million. Some investors saw bonds they'd bought only weeks earlier fall to just 12 cents on the dollar. Then came First Brands, an auto parts manufacturer. Investigators say the company pledged the same collateral to multiple lenders. Imagine taking out 3 different mortgages, using the exact same house. That's essentially what regulators believe happened. Lenders thought the company carried moderate debt. Instead, its real leverage was roughly 4 times higher. Major institutions including UBS and Jefferies were caught in the fallout. Now, 2 bankruptcies don't cause a global financial crisis. That's not the concern. The concern is what they reveal. If sophisticated lenders couldn't see these problems, who else might be hiding similar ones? Jamie Dimon summed it up perfectly after these cases. When you see one cockroach, there are probably more. Quick one before we continue. Stories like these disappear from the news in a couple of days, but this channel keeps tracking them. So if you want to follow how this develops, subscribe. And let me know in the comments, do you think these were just two isolated cases or the first cracks in something bigger? Now back to the story. Because we're getting to the part almost nobody talks about: leverage. Because this system doesn't just lend money, it borrows huge amounts too. Today, hedge funds have borrowed around $3.4 trillion through what's called the repo market. Think of repo as an ultra-short-term loan. You temporarily hand over treasury bonds as collateral, borrow cash, and promise to buy those bonds back a day or two later. Many hedge funds use these loans to run something called the basis trade. They're trying to profit from tiny price differences in the treasury market. So to make meaningful money, they borrow heavily. Some funds use leverage of 18-to-1. Imagine buying an investment using only 5% of your own money. Small gains become big gains. But small losses become disasters. Here's where things get dangerous. The same treasury bond can be used as collateral, then reused again. Think of one car being pledged as security for 3 different loans. Everything works, until everyone wants the car back at once. That's what's called a collateral chain. When those chains break, everyone rushes to sell. Prices fall. That forces even more selling. And suddenly, even the safest market in the world starts panicking. We actually saw a preview of this in March of 2020. The Federal Reserve had to inject trillions of dollars to stabilize the treasury market. And here's why this matters even if you never invest in private credit. Because these institutions aren't isolated. Banks lend money to them. Insurance companies invest alongside them. Pension funds allocate billions to them. The traditional financial system and the shadow system are deeply connected. If one starts struggling, the other won't simply ignore it. We're already seeing signs of stress. Earlier this year, Blackstone's flagship private credit fund received nearly $4 billion in redemption requests during one withdrawal window. Instead of restricting withdrawals, Blackstone injected hundreds of millions of dollars of its own capital. Meanwhile, publicly traded private credit funds trade well below the values reported on their own books. That's important. Markets are effectively saying, "We're not sure those assets are worth what you say they are." Now, to be fair, this doesn't automatically mean another 2008 is coming. There are important differences. Unlike banks, many private credit funds lock investors in for years. That makes classic bank runs much less likely. And some analysts argue that Tricolor and First Brands were simply isolated fraud cases. That's a perfectly reasonable view. But here's what nobody argues about. This market has never experienced a major recession. It exploded during one of the easiest money environments in history. Interest rates were low, credit was abundant, defaults were rare. Nobody knows exactly how these assets behave during a deep global downturn, because we've never seen it happen. And that's really the story. The biggest part of modern finance is also the part that's hardest to see. The market continues getting larger, the connections keep growing, and if stress appears, it won't stay hidden for very long. The last financial crisis started in the part of the system most people ignored. Today, that part of the system is even bigger. The only question is whether it's stronger, or whether we're simply looking somewhere else while the pressure keeps building.